the Foundation for Economic Growth and Welfare. As you know, the foundation, the EGROW Foundation, is in policy-oriented research and advice based on policy. To chair the session today, we have Dr. Arvind Vermani, Chairman of EGROW Foundation. Dr. Arvind Vermani is the former Chief Economic Advisor, Government of India, as well as the Executive Director at the International Monetary Fund. He has been in the planning process of our country for many years. Earlier, he was in the Planning Commission, and then, of course, he was at the helm of affairs as Chief Economic Advisor, Government of India. He has published extensively in journals, refereed journals, and also he has books to his credit. He is a keen scholar. Even when he was the Director General of EGROW, he was publishing all along. Dr. Virmani's specialization is in planning and also other socioeconomic issues like poverty, malnutrition, and he is expert on fiscal policy also. With this, I hand over the session to Dr. Virmani to carry forward the proceedings.
Thank you, Chairman. Let me start immediately. We have only 1 hour, including for questions. So let me briefly introduce Dr. Eswar Prasad. He is the Tolani Senior Professor of Trade Policy and Professor of Economics at Cornell University. But he is also Senior Fellow at the New Century Chair in International Economics at the Brookings Institution and Research Associate at the National Bureau of Economic Research. He has previously served in the IMF, where I met him and have known him since then, as the Chief of the Financial Studies Division Research Department and Head of the IMF China Division. So he's a China expert, but I'm sure we won't have time to go into other issues besides the ones he touches on. Briefly mention his books, The Future of Money, How the Digital Revolution is Transforming Currencies and Finance, which I presume is going to be the main core of his talk today. But he has also written Gaining Currency, The Rise of the Renminbi, and The Dollar Trap, How the US Dollar Tightened Its Grip on Global Finance. He created this Tiger Index, tracking index for global economy, and he has testified with the Senate Finance Committee, House of Representatives Committee, US-China Economic and Security Review Commission. And he also writes in the articles in the top US and UK journals. So with that, let me hand it over to you, Eswar. So the floor is yours.
Thank you, Arvind, for that very kind introduction. And it's really a pleasure to be part of an event organized by the EGROW Foundation. It is great to see intellectual leaders in India, such as you, Arvind, and Charan, taking such an important role in guiding the intellectual and policy debates in India in the right direction. Our country certainly needs more such informed debates. I'm delighted to be part of an event organized by your foundation. So this book, The Future of Money, actually had an interesting path. My original intention was to write a slim volume about central bank digital currencies, something that is becoming quite important a topic these days. But as I started thinking about the issues involved in seeing this from a central banking perspective, it soon became apparent to me that one needed to put this in the broader context of what is happening in financial markets, starting with the very basics of the fintech revolution. But then, of course, that fintech revolution has given rise to cryptocurrencies, which have taken on a life of their own and are creating new technologies that I think have very important potential in transforming financial markets and institutions. And then, of course, CBDCs themselves raise a whole host of questions. And all of this put together is going to have implications for the structure of both financial markets and institutions, also for monetary policy in both, the active conduct of monetary policy, but also managing financial stability, and ultimately some implications for the international monetary system as well. which is why what was intended to be a small volume turned into a 500-page tome that covers a lot of ground. So when one starts at the very beginning with fintech, which is this broad term for thinking about new financial technologies, one immediate question is, what is new and special about this round of financial innovation? After all, financial innovation is nothing new. You know, the creation of money was itself a dramatic financial innovation, which transformed not just commerce, but human society in some ways. The creation of paper currency in China in the 7th century, and then the creation of unbacked legal tender in the form of fiat currency by Kublai Khan's government in China in the 13th century was another innovation. So there have been many innovations along the way, including the introduction of ATMs in the 1960s in the US. What I think is very striking about the new wave of financial innovation is that it is built on digital technologies, and that has two very important implications. One is that it makes it a lot easier for new players and entrants to enter and not just provide new ways of doing old forms of business, but to really think about conducting finance in a completely different fashion that I think is going to have very significant effects. In addition, we see the ability of digital technologies to allow these new products and services to be scaled up in a manner that existing financial products may not be. So if you think about traditional commercial banking, brick and mortar operations are not very easy to scale up, but once you move things onto digital platforms, the marginal cost of adding in new customers who can get new services and products is really quite minimal. So that changes the nature of the game in a very important way. And we are beginning to see the benefits of this fintech revolution touch both rich countries and poor. We've seen the spread of mobile money in low-income economies, and it's having an impact even in richer economies where financial inclusion is certainly less of a concern, but is still a bit of a concern. Even in the US, about 5% of households remain unbanked or underbanked to this day. So the ability of using fintech platforms to provide basic banking products and services, that is certainly going to have very important effects. And of course, we are seeing fintech beginning to play a role, not just in terms of payment mechanisms, but also in terms of banking, with online banks, with challenger banks beginning to play an important role. And essentially, we are finding new ways to get around traditional financial intermediaries. So for instance, directly connecting savers and borrowers using fintech platforms. Now, at some level, the fintech revolution has already made huge progress, but it's worth keeping in mind that we should consider this from a critical perspective about whether, in fact, these new technologies can scale up to the extent that they pose a serious threat to the traditional financial intermediaries, and more importantly, whether technology can really solve all the problems that beset finance. And this will be a recurring theme in my talk, whether technology can be relied upon without the government or regulators creating guardrails to operate in a fashion where you see many of the benefits without attendant risks. If you think about the ability of payment providers, say in China, to provide low-cost, easily accessible digital payments, that's certainly a huge win for these new fintech platforms. Fintech platforms in China, and of course in many other countries, including India, have of course also been able to provide basic products and services, in many cases using data from payment platforms in order to get credit scores and broader measures of creditworthiness. In some cases, these are working well, but I think the jury is still very much out on whether fintech platforms are doing a good job at evaluating and managing credit risk. So I think it's worth keeping in mind that fintech has a lot of potential, but the notion that we can leave fintech to itself without creating guardrails to prevent spillovers of risk to the traditional financial system is not something we can take for granted. Now, amidst the fintech revolution, of course, the bright shining star, at least to some, that has emerged on the scene since 2008 is the cryptocurrency revolution, led, of course, by Bitcoin. Now, in finance, as in everything else, timing is everything, and Bitcoin's timing was impeccable. The Bitcoin white paper was released just about 6 weeks after the Lehman moment, September 15, 2008, the day when the iconic investment banking firm Lehman Brothers went under, and it looked like it might take the entire US financial system and perhaps even the global financial system down with it. So this was a time when trust in governments and traditional financial institutions was at a very low ebb. So it was a perfect time for something that caught the libertarian zeitgeist at the time very well. And what Bitcoin promised, of course, was a means of payment that could be undertaken without relying on central bank money or trusted intermediaries such as commercial banks or credit card providers, and to be able to conduct such transactions using just digital identities rather than real identities. Now, by this time, most of us know at least the basics of Bitcoin, and what it promised was, of course, truly remarkable at one level. And conceptually, I think Bitcoin is really a marvel in terms of what it promised and how it used a variety of technologies that had already been developed at that time, including distributed ledger technologies, in a very effective way to create this decentralized payment mechanism. Now, it turns out, of course, that Bitcoin does not work very well at what it was meant to do, which is to serve as a medium of exchange. Bitcoin's value relative to the unit of account, which still remains fiat currencies, is very volatile, which makes it an unviable medium of exchange for regular transactions. Plus, of course, there are technical constraints. The Bitcoin network cannot directly handle a large volume of transactions. It can process at most 6 to 7 transactions per second, which is a trivial amount compared to the hundreds of thousands or indeed millions of transactions per second that can be processed on, say, the Visa or MasterCard networks. In addition, it takes on average about 10 minutes for a Bitcoin transaction to be directly processed on the Bitcoin network. And I keep using the word directly because there are ways in which one can build layers on top of Bitcoin that can actually make it somewhat easier to use Bitcoin as a transactional medium. But still, the core problems still make it an unviable medium of exchange. Now, what this has resulted in is a whole new breed of cryptocurrencies that try to make up for Bitcoin's flaws, but each of these cryptocurrencies ends up having different features that undermine some of what Bitcoin promised. So one of the types of cryptocurrencies that has begun to gain a lot of traction is the set of stable coins. Stable coins essentially solve the volatile value problem of Bitcoin, and they do this by being backed up by stores of fiat currencies or assets that are liquid and denominated in fiat currencies. And of course, there is a delicious irony here because the entire point of Bitcoin was to get away from fiat currencies, but the cryptocurrencies that seem to work well as mediums of exchange do in fact have to be backed up by fiat currencies. Now, one question is why stable coins? And the reason seems to be that these are fulfilling a need that is there for better payment systems, both domestically and also in terms of cross-border transactions. In fact, cross-border transactions are one area where I think we will see significant benefits from the new technologies created by the cryptocurrency revolution, because that area is beset by a variety of impediments and inefficiencies that are ripe for disruption through technological change. So stable coins are promising something that I think there is a real latent demand for, but of course they come with one key attribute that differentiates them from Bitcoin. In addition to their being backed, they're centralized. That is to say, the validation of transactions using stable coins is no longer through a public consensus mechanism a la Bitcoin, but are undertaken by specific institutions, agencies that issue these stable coins. So we are getting some benefits in terms of better payment systems, but without the decentralization that was a key characteristic of Bitcoin. In addition, there are other cryptocurrencies that provide much stronger anonymity than Bitcoin does. So for instance, there are cryptocurrencies such as Monero and Zcash that have much stronger encryption algorithms that give you much greater anonymity, but there it turns out that they come at the cost of ease of use. The user interfaces are just not that intuitive yet. So the ability to use these sorts of cryptocurrencies in a truly anonymous way for undertaking transactions is not really working very well. Now, cryptocurrencies, of course, have become a huge market, and one of the great ironies is that while Bitcoin and other decentralized cryptocurrencies were meant to serve as mediums of exchange, and as I have just argued, they're not working well in that function, at some level they have become pure speculative financial assets. Now, having written a book about digital currencies, I go to a lot of cryptocurrency and Bitcoin conferences, and I get a lot of pushback from people telling me that surely something like Bitcoin that is scarce relative to a fiat currency such as the US dollar or the Indian rupee that can be printed essentially in infinite quantities by a central bank, surely something that is scarce must hold value better. To an economist, this is a somewhat dubious proposition, or at least to this economist. Just because something is scarce, especially when it does not have any intrinsic value because it's not fulfilling its basic functions, it's not obvious at all that it should have significant value, let alone the sort of value we are seeing for a unit of Bitcoin, which when I checked a few minutes ago was a little north of $40,000. So it's hard to imagine this being something that can have durable value over the longer term. But having said that, what Bitcoin has set off really is a very important technological revolution that I think is going to be lasting in many ways. The blockchain technology bequeathed to us by Bitcoin is, I think, going to be its true legacy. And we're already seeing very exciting new products and services being built on blockchains. Not necessarily the Bitcoin blockchain, which actually has very limited functionality, but there are newer blockchains that I think are showing the promise of decentralized finance. Now, when we speak about decentralized finance, it's worth thinking for a second about what exactly decentralization means. So in my book, I rely upon the wunderkind who created what is now the second largest cryptocurrency, which is Ethereum. And he talks about, Vitalik Buterin talks about three elements of decentralization. One is the decentralized architectures. Essentially, blockchains are built on distributed ledger technology. So you have a lot of security and resilience coming from the fact that these public ledgers are not only public, but they're maintained on multiple nodes at the same time and synchronized in real time. Second, you have decentralized consensus or decentralized trust. So you don't have any specific agency in decentralized finance that validates transactions and makes sure that the records are tamper-proof. And third, you have decentralized governance. That is to say, you don't have any agency or government institution that is managing these networks and these products. Essentially, you have the community self-policing itself. And the idea is that it is in the self-interest of the community to make sure that the system remains secure and tamper-proof, because if not, those who are already invested in the system would stand to lose quite considerably, both financially and otherwise. Now, decentralized finance, again, seems a little magical at one level, but in fact, it is working. There are products such as flash loans that allow you to borrow large amounts of money without posting any collateral, undertake financial transactions such as arbitrage operations across different financial markets, pay back that money with a fee, all within literally a flash of an eye. And what is interesting about a flash loan product is that it actually not only works, but it actually eliminates the kind of risk that we are typically used to thinking about in financial markets, lists such as liquidity risk and credit risk. And the reason you can minimize those sorts of risks is because of a property called atomicity, essentially that all the legs of the transaction have to be completed before the entire transaction is finalized. So if you think about borrowing money, using that money to conduct an arbitrage operation, paying back the money, all of those legs of that transaction have to be completed sequentially and again, literally in an instant. And if any one of them fails, the entire transaction unravels. This again sounds almost magical, and I was quite skeptical when I heard about this, but actually it turns out it does work reasonably well. Likewise, we now have smart contracts, which are essentially pieces of computer code that allow us to essentially conduct financial transactions, either swapping one financial asset for another financial asset or money, or perhaps even tokenizing real assets such as houses or cars or pieces of art for that matter, and being able to transact them using the blockchain to ensure that there is security of ownership. So this all sounds very good, and like I said, it is working, but this is not to say there are no risks. There are some risks related to, for instance, the fact that you have the community governing itself. One of my Cornell colleagues, Ari Jewels, had this very interesting research program where they showed that there was a particular vulnerability of a DeFi or decentralized finance protocol. Now, it turned out that you could undertake certain front running of transactions. So essentially, you could complete transactions at an unfavorable price to whoever proposed that transaction before it could be canceled. And all of this happens literally in nanoseconds on these networks. So before you can cancel an order that is placed at an unfavorable price, you could have a bot step in and fulfill that order at that unfavorable price. And complete it and make off with the difference in price. Now, what my colleague Ari and his colleagues did, because there was nobody to report this vulnerability to, is that they put out a blog post saying, hey, community, let's go fix this problem. And sure enough, because DeFi is largely based on open source code, within a few hours, that problem was fixed. But within those few hours, a cottage industry of bots emerged to exploit this vulnerability. So not a huge amount of money was made off with, but when you think about the fragility of the trust that underlies decentralized finance, one worries about whether vulnerabilities of this sort could potentially undermine the system. So there are a variety of technological and conceptual vulnerabilities that I think make it hard for us to envision a world in which decentralized finance essentially takes care of itself without the government setting up guardrails. But it's creating a real conundrum for regulators around the world. Just yesterday in the US, Janet Yellen, the US Secretary of the Treasury, gave a speech where she talked about the potential benefits to be gained from many of these innovations set off by cryptocurrencies, but also pointed out that we need to think about regulation to make sure there are guardrails in place at a minimum to ensure investor protection and ensuring that people who start using these products and services have a minimal level of financial literacy, but also to think about how one can insulate the traditional financial system from potential spillover risks from this non-traditional part of the financial system. So while governments are thinking about how to deal with these regulatory challenges, one of the new elements that has emerged from the state, of course, is the appearance of central bank digital currencies. Now, CBDCs are seen largely as just digital versions of the physical versions of fiat currencies that are now issued by national central banks around the world. And one question is whether, other than the digitization, this really is a fundamental transformation in any way. Certainly, around the world, in many countries, from both developing to rich countries, cash is disappearing very fast. In India, of course, cash is fast plummeting in use. In China, the use of cash has declined very substantially. My last international trip before the pandemic hit was to Beijing in December of 2019, and I felt like I was literally the only person in Beijing trying to use my yuan notes to pay for a cup of coffee or for a taxi ride. Virtually everybody there uses one of the payment systems that are based on mobile phone apps. So we have cash disappearing, and one might argue that what central banks are doing is basically taking a defensive posture where they want to make sure that their money is still relevant at the retail level. Now, it's worth making one analytical point before we go forward, that even if a central bank stopped issuing money that was used for retail transactions, this does not mean that the central bank becomes impotent. A central bank can still control the cost of funds by managing the interbank borrowing rates, such as the discount rate or Fed funds rate in the US. And there are other policy rates that the central bank can control, even if it was not issuing retail money. But certainly one might argue that there is some value to having a central bank still issuing retail money that is widely used. So it's worth thinking about what the imperatives are that are leading central banks around the world to either experiment with or consider experimenting with CBDCs. So if you think about a country like the Bahamas, which is the first in the world to issue a nationwide CBDC, that is similar to what many other developing countries seem to have in mind, which is viewing a CBDC as providing a path to greater financial inclusion by giving everybody in an economy, even low-income, low-net-worth households and individuals who may not have easy access to a bank account or a credit card, to give all of them easy access to a low-cost digital payment system. In a country like Sweden, on the other hand, there is a different set of motivations at play. In Sweden, the private sector is doing a fantastic job of blanketing the economy with digital payment access, but the Riksbank, the Swedish central bank, is concerned about technological and confidence vulnerabilities that could hit the payment system if the entire payments infrastructure was in the hands of the private sector. So the digital kroner or e-kroner project is seen as a backstop to a private payments infrastructure. So there is a financial stability imperative at play. China has a third set of motivations. In China, Alipay and WeChat Pay have done a fantastic job of saturating the economy with low-cost digital payments, but the government is very concerned that these two payment providers are limiting entry into the payment space, which could also limit innovation. And more importantly, they've been gathering up troves of data, which until recently they were not willing to share with the Chinese government. So the People's Bank of China, the Chinese central bank, seems to view a digital renminbi or digital yuan as basically a way of keeping central bank money relevant at the retail level, and also, in a sense, providing a mechanism by which other payment providers might still have a role to play, despite these two payment giants, Alipay and WeChat Pay, dominating the payment space. Now, central bank digital currencies have a variety of positive aspects. They pull a lot of economic activity out of the shadows, which is a very relevant concern for many emerging market economies, particularly those in Latin America, where the shadow economy tends to be very large. The use of central bank money for illicit purposes can be mitigated if you have digital money. And there are certain monetary policy operations, such as these helicopter drops of money, essentially direct transfers of money, sort of like the coronavirus stimulus payments we had in the US in 2020, being made much easier. There are risks, of course. There are risks that you might have disintermediation of the banking system if the CBDC took the form of CBDC accounts or digital wallets. So you could have deposits flying from commercial bank accounts to CBDC accounts. You could have the government, limiting innovation in the private payment space if you had the government providing payment services. And then, of course, there is a concern about privacy if we have digital payments being the only option that is available to consumers and businesses. So this might be very convenient, but gives up any vestiges of privacy that may be left to us in our day-to-day transactions. It turns out that there are ways through both technical design and also conceptual design to mitigate, if not completely eliminate, these risks. So for instance, the way that China and Sweden are setting up their CBDC experiments is through a dual tier architecture, where essentially, much like the central bank provides cash to commercial banks in exchange for reserves, and then the commercial banks go out and distribute cash to their clients, who might be consumers or businesses. Similarly, one can set up the CBDC as essentially a digital token, but the front-end management of digital wallets in which those CBDCs are maintained is managed by commercial banks. So the payment infrastructure at the back end is provided by the central bank, while the front end, that is to say the payment services that are provided to consumers and businesses, can be intermediated by commercial banks or other payment providers. So you could end up in a situation where central banks are basically just providing their money in digital form rather than physical form, but they stay out of direct involvement in the payment space. And also, there are ways, simply by putting a cap on the amount of money that can be kept in a CBDC digital wallet, for instance, that you can mitigate the risks of flight of deposits from the commercial banking system. So I think we are moving to a world where CBDCs are becoming essentially a reality because cash is disappearing. But I think we have to think about this very seriously on a case-by-case, country-by-country basis, whether there is really a user case for a CBDC. In the US, the Federal Reserve has just put out a policy paper where it talks about a variety of questions that need to be discussed in the public domain before it moves forward with the CBDC. And I think the Fed is doing the right thing by saying that it will move forward with the digital dollar only if there is broad political and public support for this. The Swedish central bank is taking a similar approach. When it comes to countries like China and India, I think this is a question that we really need to ask. Given how well UPI is working in terms of providing a payment infrastructure, in terms of making sure that everybody has access to a low-cost digital payment system, in countries like China and India, there is a legitimate question to be asked: what additional value do you get from a CBDC? I think there is a positive answer to that question in terms of what a CBDC can do, but certainly in countries like this, where the private sector is doing a very good job providing front-end payment systems, and especially if you take the India example, which I've been holding out as an exemplar in many ways. It's not perfect, but I think in many ways it's an exemplar for the rest of the world in terms of where the government should be involved at the back end rather than the front end. I think these are questions that are certainly ones to be confronted. So let me wrap up by just talking about what all of this might mean for the international monetary system and for monetary policy in particular. I think there are going to be some challenges to monetary policy transmission and implementation as the structure of financial market shifts. The one thing that distinguished monetary policy officials and the government officials like Dr. Virmani and Dr. Singh know is that the transmission of monetary policy to economic activity and inflation, is a bit of a mystery, especially to academic economists. The one thing we sort of understand is the banking channel. So when the central bank alters policy rates, we have a good sense, or at least a reasonable sense, of how commercial banks change their deposit and lending rates and how that then gets transmitted to real economic activity and inflation. But if commercial banks start playing a less important role, if you have fintech platforms or other types of financial institutions beginning to gain much more prevalence in an economy, it's not obvious how monetary policy might work well anymore. In fact, there is some academic evidence from the US and China that the shadow banking system actually works in a pro-cyclical way. That is to say, when a central bank is trying to tighten credit, those parts of the financial system actually aggressively expand credit. So monetary policy implementation is going to become a lot more, and transmission is going to become a lot more complicated. Likewise, financial stability becomes a lot more complicated, especially if you think about times of crisis when a central bank might rely on its lender of last resort function. It's relatively easy for a central bank to infuse liquidity into the financial system through institutions like commercial banks that are connected to it. But again, if you have non-traditional financial platforms playing an important role, it's not obvious anymore how exactly that lender of last resort function is going to be fulfilled. So in my book, I raise a whole host of these questions, which I think are going to be dealt with. Is the digitization of the renminbi fundamentally going to change the international monetary system? My view is not really. Certainly in the last few weeks, especially with the Russian invasion of Ukraine, we've seen a variety of measures being taken by the US and other Western economies, which have raised questions about whether the primacy of the dollar or about Western reserve currencies more broadly is going to be seriously challenged by an evolving new financial system. My view is that China's cross-border interbank payment system actually might play a more important role because that can more directly communicate with the payment systems of other countries. It could potentially even be used as a messaging system to bypass SWIFT, which at its core is just a messaging system. So we might move to a world where the dollar's role as a vehicle currency in intermediating transactions between, say, rupees and rubles, or renminbi and rubles, or rupees and renminbi, that's going to decline. But I still think that the dollar will remain perhaps the most important payment currency, even if its importance declines. But as a reserve currency, my long-held view has been that it's not just financial market depth or economic size that matters, but ultimately a country's institutions, including an open and transparent system of government, the rule of law, an independent central bank, all of which are necessary to maintain the trust of international investors. So I don't think there's going to be a fundamental shift in the structure of reserve currencies that is coming, but that's certainly an interesting question to think about in light of recent developments. But there are some challenges coming, especially for second and third tier currencies, currencies of countries that are very small, of countries where the central banks or currencies that are not credible. Those, I think, face existential threats. If we move to a world where a digital dollar, a digital renminbi might be easily available around the world, or even a stable coin issued by a mega corporation such as Amazon or PayPal becomes easily available, that could very easily displace some second or third tier currency. So I think there is a bit of a shakeout coming at the bottom end of the international monetary system, perhaps a little less so at the top end. So let me just sum up by saying that I think we are moving to a world set off by digital technologies that are going to be very beneficial to humanity in many ways. But I think we should keep sight of the fact that technology is not going to solve all problems. If we think about decentralized finance as democratizing finance, the promise and potential is certainly there. But we could equally end up in a system where technology leads to even more concentration, and we end up in a world where many of the risks of these new technologies are borne by those who are least able to deal with those risks, while at the same time you have a much greater concentration of economic and perhaps even political power. And of course, there is the real prospect that we might be moving to a world where central banks and governments have even more intrusiveness into our private lives, both economic and financial and even social, because digital money, while it can be a powerful tool for equality, can also be a tool that can be manipulated in ways that might serve big corporations or authoritarian governments in ways that might not work out very well for the common man. So let me just wrap up by invoking the title of the last chapter of my book, which I think subsequently I use quite clearly. A glorious future beckons, perhaps. Thank you.
Thank you. Very concise and well-flowing talk. It's actually very timely because a few weeks ago I had an opportunity to actually understand the technical points behind crypto, and it suddenly kind of everything became clear. But I think you, of course, touched on many other experiments, etc., which the technical persons didn't really know about very well. So I, after that, learning about it, and it relates to your talk actually, I have actually proposed two things for India, and what I would like you is to, because you thought about all these things, to comment on it brutally. So one is the UPI system actually, which is public good, digital public goods, you rightly pointed out, is one big innovation. It is going to continue, that the government's focus really is going to be on what platforms and public goods which will promote competition in the private sector. It's not to create monopolies. So one of the things which actually I have proposed is the UPI. As I said, I'm beholden to the person who gave me the technical knowledge, so who was an IIT professor. But a UPI, all it needs to be a currency. If you think of the stuff we have in our wallet, I also still have the rupees, with the 500 rupee notes, 2000. All it needs is you need to add to the UPI an anonymity protocol, and the UPI can then and put limits, exactly what you are saying, that transaction below some limits in certain quantities, that anonymity protocol will apply to those, then it becomes exactly like a paper currency, but in digital form. So that is not a difficult thing to do. So that is one proposal for the RBI to create a retail currency, as you called it, or a digital currency for small transactions, like now we do for whether it's a 10 rupee note or 6 rupee note or something. But the key thing there is the anonymity protocol, which does not exist in the UPI. But technically, that's not a difficult thing to do. That could be added for small transaction, which basically makes the use of UPI possible for as a kind of digital version of the standard currency. That's one proposal. The second one, which is post-Ukraine, and more important is really, I would like your views on this, is that one can create an organization which convertible digital rupee, which in a way is controlled by the central bank, and it can determine the size of that market, and it will be known to the public. No secret that this will be a fully convertible, fully backed. One could set up an organization which does the conversion. RBI or government or a combination decides how much, what's the trajectory we are going to have, and make it fully convertible. So the importance of that is everything doesn't become convertible at one go, and you can control the pace of convertibility, so to say. So particularly on this one, and I don't really technically see any difficulty, just like you said, what is it, stable coin. It's kind of like a stable coin, but put out by the central bank, and we'll call it a convertible rupee. So if you can just react to these 2 points, then we'll take some more questions if there's time.
So on the first issue, Arvind, that's an important one. In fact, I think privacy is the key concern that is relevant for CBDCs. When the Eurozone conducted a survey of its citizens, privacy came out to be the biggest concern they had about a move to a CBDC. It turns out that there are technological ways of mitigating this. So in fact, China, and you can read all about this in my book, has proposed 5 grades of digital wallets. So for using the ECNY, the highest grade digital wallet could be used for storing larger balances for large value transactions. That has to meet know your customer requirements and a variety of other regulatory requirements. But there are very low grade digital wallets which can be used only for low value transactions, can be used only to maintain small balances, where there are no such requirements. All you need to provide is your mobile phone number in order to access that. Now, having said that, the reality is that while there are new technologies, including something called zero knowledge proofs, that might allow us to get to a world where people can show their bona fides while their transactions are kept private to a large extent. The reality is that anything digital is going to leave a trail, and no central bank really wants its money to be used in a way that is not auditable and traceable. So I think we will come to a world where with this technology, we're going to get to a point where very low value transactions might in fact still assure us a reasonable amount of transactional privacy, while any higher value transactions are going to be subject to digital audit trails. So that technology is already out there, and even China, like I said, is trying to make the case that its digital yuan will actually give people a little more privacy than commercial payment providers might. So building this on top of the UPI could certainly be done, but again, one could think about front-facing payment providers providing these mechanisms, although certainly one could think about building it into the UPI as well for low-value transactions. On the other issue,
on the other one, but before the other one, so the whole structure exists, and the part of the limited, I mean, you said control over currency, but when we issue cash, there's no control over it. Huh? So it's exactly the version of cash. The amount of cash in the system is controlled. So I don't see, well, technically, I've talked to the engineers that there's no, it's very easy to introduce an anonymity protocol with certain rules. And, so it becomes exactly like a digital version of a rupee, which has a stamp. I mean, and it's actually safer because there's no, you can't counterfeit it because there's a system which cannot be counterfeited as far as we know. Anyway, so the other one, yeah.
Yeah, so, I mean, just to wrap up that issue again, the question is whether you want to limit it to low-value transactions or not. And I think that might be the compromise we arrive at, that for very low-value transactions, you can assure people anonymity. And for higher-value transactions, there is a more easily auditable trail.
That's the proposal. So I just wanted to know for whether you think that's, I mean, you have anything against it or...
I think we're moving to that world because, again, cash is disappearing. So the question is, how best do we construct a digital version of the rupee or any other fiat currency in a way that balances these considerations, where the central bank wants to make sure that it can, in fact, ensure that its currency is not used for illicit purposes while retaining some degree of privacy. And as I mentioned, China has already indicated that you can manage that balance. On the second issue, if I understood correctly,
I don't get that because for the currency which is there, you can't do, for the small amount of cash which is in the system, you cannot control if it's used for illegal or not. You can control if it gets into the system, and the same thing will apply to the retail digital currency. It's the same thing. It's like if there is cash and somebody takes, there can be a limit. Here we can take 1 crore of cash and give it to somebody. That would actually be limited in digital. So it's actually less usable for illicit transaction. I just heard recently about somebody bringing 2 cases of cash to give for buying somebody's house. So, but that will not be possible, or you'll have to stagger it. You'll have to do it in 10 transactions. But anyway, so, okay, sorry. And the convertible currency, because there I think you have a lot more experience.
Yeah, I think we are actually agreed on this thing, Arvind. What I'm saying is that what you will move to is a world where you cannot use digital currency for large value transactions without auditability, which is exactly what you seem to be suggesting as well. We don't want to live in a world where you can use huge amounts of digital currency in a way without auditability, but with small value transactions, maybe you want to retain that ability. But if I'm not clear on this, maybe we should talk about this.
No, there's no disagreement. It's only the way you put it, I thought. Anyway, so the convertible currency?
So if I understand correctly, what you're proposing is a convertible currency that could be used as a reserve asset by other countries. Is that correct?
Anybody in the world could use it.
Yeah. So to my mind,
provocative. If Russians wanted to use it to pay the Chinese, they could use it. Of course, they're not.
Yeah. So that's, I mean, one can think about this in the context. Let me think about the Chinese renminbi, for instance. It's now an official reserve currency. It's in the STR basket. Could it become a major reserve currency? Could it become even a safe haven currency? Now, in China's case, much like in India's case, the renminbi is not fully convertible. The exchange rate is to some extent managed, much more so than the RBI doesn't seem to manage the exchange rate the way the PBOC does. So those are 2 considerations. But in addition, there is the question whether foreign investors are going to trust the renminbi. Now, it turns out that in China, foreign investors now have very easy access to domestic renminbi denominated bond markets, both government bonds and also corporate bonds. So the question is, what is preventing from the world now from viewing the renminbi as a major reserve currency? What could prevent the world from seeing the Indian rupee as a major reserve currency if convertibility was ensured? So my view again is that it's going to be important to think about what is necessary to ensure the trust of international investors. I don't know about you, but I might be a little reluctant to put more than a few millions of dollars in the Chinese bond market because the rules of the game could be changed at any minute. So will foreign investors really see the renminbi as a safe haven currency? To my mind, that requires a very strong institutional framework. And I mentioned the elements: an independent central bank, the rule of law that even the government is subject to, an institutionalized system of checks and balances. And I think China has shown very clearly that it is regressing rather than progressing on these areas. India, I think, is much stronger in terms of the institutional framework. Again, our government does get taken to court and sometimes it loses. And that sort of element where the rule of law implies that even international investors are going to get treated fairly, I think is very important for a reserve currency. So in addition to making the rupee more convertible, which seems to be the technical element of your proposal, Arvind, I think the institutional framework is really the important issue. Plus, of course, making sure that foreign investors have easy and unfettered access to the fixed income markets and that capital controls are quite limited.
So here's the thing. Sorry, I'm sorry I'm taking up everybody's time, but the whole point, as you know very well, there is a payments part of it, which is small, but still important. And there is the asset part of it, right? For a convertible currency, clearly matching anything like the US, UK, or Japan, as far as the asset side is concerned, is not on right now. That's precisely why we are talking about a limited digital currency for use in payments. But of course, even if they are using it in payments, they want to be able to park it and be secure. I agree with that. So but the whole point of it is you can create a digital convertible currency which has its own set of rules, which are then enforceable to the satisfaction of whoever holds it. So it's possible to have a completely much more, exactly what the users want. For example, if they want to have any dispute settled in UK, you could say that for this particular currency. So anyway, you're right. I think maybe we'll discuss this separately. But last reaction.
This is an important set of issues. And we can discuss this more offline. But I think the important thing to keep in mind is, digitization of a currency by itself is not going to fundamentally alter its role in international finance. If you think about international payments, they're already digital. But what you're suggesting is something that goes a few steps beyond. You're thinking about a digital version of the rupee that somehow has different characteristics in terms of convertibility and so on. But this again comes up against the fact that, that is, if you think about that as being a different currency than a traditional Indian rupee, that's going to create some instability in the monetary system because you have two currencies issued by a central bank that have different characteristics and properties. And I would worry a little bit about what that does to the integrity of the rupee.
Okay, yeah, that's a good point. That's exactly what I wanted. Okay, thank you. So, Charan, do you see any questions? Because we are going to run out of time.
I do some questions, but I think partly they have been answered. But as for this has been a brilliant talk. I think the book has to be read by all of us. Sorry, I haven't read it so far. And I think Dr. Virmani has provided a great discussion. My quick question would be, Dr. Virmani's suggestion is beautiful. I thought depending on the risk-taking capacity of the government, one could introduce this alternate currency, which is convertible, and all this blame and all this complaint that India does not have a capital account convertibility, that could be partly taken care of. So I think it's a very interesting point which he has brought in. My quick question was, Eswar, I've always been wondering how would, there are two quick questions. One is the seigniorage part. How do you visualize seigniorage in cryptocurrency and of course in the central bank digital currency which you mentioned? The second part is that in a country like China, and I wanted to depend on that because you are so experienced, being there for such a long time, you say it's getting utilized, the alternate digital currency is getting utilized everywhere you go. But my fear was that in a country like India, where literacy levels may not be that high, uh, and in the rural areas, countryside, do you think in China, even in the countryside, they have adopted to the digital currency and that there's a lesson for us in India that we could adapt it to? Or you think that, of course, from 12% of cash to GDP ratio, we may come down to 2%, which is an international norm. So what is your take on that? We could continue with partly the physical rupee and yes, wherever possible, turn into the central bank digital currency.
So the experiences of, thanks for those questions, Sharon, very important ones. The experiences of many low-income countries, much lower income than India, suggest that digital payment technologies are really a boon to consumers and businesses, especially small businesses, which then don't have to deal with the hassle of dealing with cash, which are not subject to loss of theft of cash, and have an easily auditable record. So if you think about mobile payments in countries like Kenya, Somalia, and so on, those have been a resounding success because bank penetration rates are very low in those countries, but basic mobile phone penetration is upwards of 95%. And it turns out you need minimum levels of literacy.
Please put your mute yourself. Somebody is talking. Please mute your button, please. ये कौन है?
కిటికీ తెలిసిన ఇది నా మూసే ఉన్నా
Vivek, can you mute everybody?
నేను సోను అనుకుని ఉంటే
Who's talking? Please mute
తెలిసినోడు
yourself.
సై ఇట్లే ఉంటుంది నీకు
So let me try to persevere, Charan. So I think there are benefits to be had from digital payments. Now, just to be clear, in China, the digital currency, the ECNY, is still in experimentation phase. It's not been rolled out nationwide. And in fact, the take-up has been very limited so far, precisely because Alipay and WeChat Pay are being used by practically everybody in the country, whether you're literate, illiterate, poor, rich, whether you're in an urban or rural area. So that's really taking over. And I think that's going to be the future, really, the notion that we're going to shift towards digital payments increasingly as we move towards a more technological economy. And I think there are concerns even in the US about, the poor, the technologically, unsophisticated being disenfranchised if we lose the use of cash. But I think that concern is being fast dissipated by the reality that very basic mobile phone apps, and you don't even need smartphones for this, are getting us to a path where we can easily undertake these functions.
Yeah, I think, in India now we have enough experience of mobile wallets. I don't see, the next step is exactly what you're saying. We are in that process of designing an app or a system which can be used on an ordinary phone, which will connect to the UPI. So many of the payment wallets which we have are working through the UPI when there's an interbank element of it. If it's within the thing, that's fine. But so you have two different private payment systems. They basically connect through the UPI. And the initial ones, of course, required some kind of smartphone. I think within the next 6 months, we are going to have a system which they are devising where you can do the transaction on an ordinary phone, the good old-fashioned phone. You don't need so that's going to happen very soon. So
I think that future is already here. The future of digital payments, I think, is here. And the question really is how best governments, central banks can take advantage of these developments without endangering, their ability to conduct monetary policy effectively or manage financial stability. So I could go on these.
My point was only about that, because that's technical for most people. We can discuss separately. But the point about this inequality stuff, I don't see that. I mean, from all the developments which have already occurred in India, I don't see how it would, disadvantage even rural or any other parts of the
I think in terms of basic payments, we are definitely moving to a world of greater financial inclusion, which I think is a very good thing. But again, when I think about people, investing in cryptocurrencies and so on without a clear understanding of the risks that they're taking on, there I worry a little bit. So I think what cryptocurrencies and the technology they're giving to us is leading us to a world where I think we can see enormous benefits in terms of democratization of finance. But without adequate digital access and financial literacy, we could end up in somewhat more adverse outcomes.
Yeah, crypto, I 100% agree. I recently call it the digital tulip bubble, but anyway, that's a completely different thing. And now that I understand the technology, it's too much hand waving, because people get fooled so easy. But once you understand the technology behind it, it's just it's simple. But that doesn't mean all the technologies underlying blockchain cannot be used. They've been around for 50 years and lots of innovations can now take place. Yes, that's true. Okay, great. I think that was excellent. I don't want to keep you beyond your promised time, but perhaps we will continue offline. Some part of the discussion we haven't completed. Charan, you and I and Eswar can probably have a small session sometime privately. So thank you
very much for hosting me. I really appreciate it.
But let me hand it over to Charan. He has to just make some concluding comments. Yeah.
Eswar, thank you. Excellent discussion. I know you're running out of time. The recording of this will be available on our website tomorrow by noon. We'll send you the link also. And if you are in a rush, you probably could disconnect and go.
Thank you so much again. It was a pleasure.
Yeah. I wanted to make one announcement, and that is next week on April 15, we have another book discussion, $10 trillion Economy, A Dream by Subhash Chandra Garg, who's the finance secretary of our country till recently. And the book is about the state of the Indian economy and the policy reforms agenda. We will have this discussion on April 15, and we will send you from EGROW the link as well as the timings. We would request all of you to please join. We will be joined by a few more civil servants who would be then talking to us about the reforms as well as the state of the Indian economy. And Mr. Subhash Chandra Garg will be leading the discussion. With that, let me once again thank each one of you for having joined us for an excellent discussion today. Thank you very much. Thank you, sir, for chairing the session. I think it was a very interesting session. Thank you, everybody. Thank you.